Hello, everyone out there. Empire Crypto TV. Once again, we're here with our shows, tutorials, teaching up and coming traders. And please be sure to subscribe and please do support our channel as we try to teach people the most basic of trading techniques. We have a number of them on our channel. Go to our YouTube channel, Empire Crypto TV. But without further ado, let's jump into it. Today we talk about moving averages. This is a full tutorial. I might not talk about everything, but I'll just try and include the most basic stuff that people can start with. Okay, so the first thing that you should understand that moving average is about price smoothing, as it's written here. Okay, a moving average is simply a way to smooth out price action over time. Okay, by moving average you mean that you are taking the average closing price of the currency or cryptocurrency or a stock. Hence I always say that these techniques that we teach here, they also do apply for cryptocurrency trading, forex trading, and stock trading. So I do not exclude none. So it says on an average closing price for a currency for the last X number of periods. I will not go into the mathematics, but let us just look into some of the most simplest moving average. One thing that you should also understand about moving average is the most basic thing here, is that when the price or when the stock or when the crypto stock or when the cryptocurrency or when the currency is strong or when the instrument is strong, the moving average comes beneath the candlesticks, as you can see here. It comes beneath the candlestick. And when the market is weak, the candlesticks comes above the candlesticks. I'd like to show you an illustration from the real chart. Let me just show you the illustration from the real chart. We have BuyBit platform here. Let me apply the moving average. Okay, you can type it right there, moving average. I want the most basic one. Go here. Right, it's dark and it's blue. I have to adjust so that people can see what it looks like. Have to have style, change the color, make it white, bright it up, and I just want to make it a bit thick as well. Okay, this is the moving average right here. Okay, when the market is strong, even here, the moving average comes beneath. And when the market is weak, the moving average comes above, like in this case. That's the most basic thing that you must understand. And when it crosses over, okay, this is the most important part, where it might just cross over, meaning changing the direction from the uptrend to downtrend. Because as you can see, the EOS, at this case, the crypto, EOS versus USDT has been a bull trend. And then here it looks to come over the candlesticks. And when the moving average comes over the candlestick, it shows that the market is gonna go down, or it's sell, or it's market weakness. So I just put it straightforward. When the moving average comes beneath, it's market strength, and when the moving average comes above the candlesticks, it's market weakness. Okay, that's the basic one. Okay, there are now various types of moving averages that has been put into place. There is simple moving average. Okay, simple moving average is the simplest type of moving average. Okay, I will not go in deep into it. That's one type of it. And you have exponential moving averages. But let us also talk about the periods before I move to exponential moving averages. The periods here I have, let me see what period I have here. I have, if I want to check, it says 9 a.m. Okay, I can change the input, go to input, then I have, okay, I can change it to 30. Okay, Let's see how it looks like if I put it to 30. It's from 9 and then I put it to 30. Let's see how the moving average will be like on the candlestick. Just wait for it. Let's see. That's it. You see, it changes. It becomes something else. It's not the same. So the more the period, the more the moving average is away from the candlestick, or it's more further away. It has that distance that it makes. I can put another figure or another moving average, and okay, let me just go to my indicators, put another moving average, maybe put it on another scale. Okay, I say moving average. So maybe probably it's also white, and this one is 30. Okay, the other one is 9. I want it to come. Okay, there's it. It says 9. Let me just adjust it, make it a bit thicker than it is. I'll go to style. Okay, the color is alright with me, color preference, but I just want to make it thick. Okay, maybe make it blue. This color, give it another color. Okay, then I say alright, there's it. One moving average is a 30 moving average, the other one is a 9 moving average. It's similar the one, say the one that we just replaced it with. So you can see 2 moving averages. Sometimes with these moving averages, you are looking for crossovers, these types of trading opportunities. Okay, these crossovers here. Okay, these crossovers are extremely important. Okay, there is a indicator that includes these moving averages, slower moving average and the faster moving average, which will go into it, which is the MACD, which is MACD, moving average, convergence, divergence. But for now, let us just focus on these ones. These are 2 simple moving averages with different time periods, or different time. Okay, this one say with different period. This one is 9, the other one is a 30 period. The 30 period one being the white one, and the 9 one, which lacks more on the candlesticks, is the blue one, moving averages. Okay, let's go further on, learning about moving average. I have 9 and 30. This is the 31 here, but this is just an example. Here they have 5, they have 62. So you can put as much as you can. I don't know what's the limit of the periods that you can put in there, but on TradingView, even if you know how to use your TradingView, you'll automatically know how to use your BuyBit platform, because it's TradingView. It's the same thing that you do on TradingView, you're also going to do on your BuyBit platform in terms of using these indicators. Okay, let's just go on. And then there is another type of moving average, which is exponential moving average. You can pick it up. Let's see if we can get it. Let's delete these ones, remove all drawings, remove all indicators. Okay, so let's see exponential moving average. Go to my indicators, type it in most of the time because it helps. Okay, exponential. Sometimes I just want to start with the word exponential. There is it right there, moving average exponential. There is it, it's blue. But now this one is a bit different from the one that we spoke about, the simple moving average. This one tends to be more quicker. Change the color, make it more thicker. Yes. So this one tends to be more quicker. And what period is it? It's also a 9 period exponential moving average, which is an EMA. Okay, sometimes you can put both simple and exponential moving average. Before I go into that, let me read about exponential moving. Although the simple moving average is a great tool, there is one major flaw associated with it. Simple moving averages are very susceptible to spikes. Okay, let me show you an example. Okay, they have an example where they do calculations and so forth. I will not go into it, but when they say that it's susceptible to spikes, it means that it cannot take into account some of the things that the exponential moving average does. Let's put both of them, for example, here in this case, so that we can see a real case scenario. Okay, I want to get another moving average. Sometimes I just put in moving average. Okay, See how it looks like. Right, it's the blue one. Okay, let me just change the color. It's also a 9-period moving average. Make it a red, for example. Trading view. Okay, this is all stuff from trading view. If you know how to use your trading view, this shouldn't be difficult for you. Okay, now here's an example of exponential moving average and a simple moving average. Exponential, you see, takes into account, and the simple moving average is just susceptible. It just moves over the market. Is just smoothing out the prices. So that's why it's called price smoothing when it started. It's just a way of just smoothing out price. But exponential moving average takes into account some of the major things that are happening on the trend. Like here, you can see that there's slight difference between the simple and exponential moving average in this case. Okay, but going further on, there are other ways simple and exponential moving average are applied. In the case of MACD, or moving average convergence divergence. As you can see, this is another an example on the PDF on putting exponential moving average and the simple moving average, two different types of moving averages. Okay. Now there are other ways that you utilize these moving averages through this indicator that I'm going to show. MACD here. All right. MACD, convergence divergence, moving average convergence divergence. Here you hear that the first is the number of periods that is used to calculate the faster moving average, possibly the green one, and then the second is the number of period that is used in the slower moving average. So these are also moving averages, but packaged in a very unique way to suit for the MACD packaging, or for the MACD indicator, solely for it, only just for the MACD. But with moving averages, you can manipulate them with your own way, also by bringing in different types of periods that you can use on your MACD. By bringing in different types of period, like here I have two different simple and exponential moving average. So I can have different type of periods, like I was doing here in this case here, just above, different time periods. Sometimes you can put both SMA 5 and 30 SMA. But what's the difference between simple and exponential moving averages? So let's just compare the two. All right. SMA displays smooth chart over which eliminates most fake outs. That's the pros. And the cons for SMA: slow moving, which may cause a lag in buying and selling signals. Okay. Then EMA, it says quick moving and is good at showing recent price swings. Okay. Then the cons for EMA: more prone to cause fake outs and give errant signals. So it's up to you how you utilize these indicators. But me, I do advise my student that to use both indicators, practice with both indicators. Most definitely they will be useful at some places and some trends that you might need them. Sometimes you might not need them at all. So do practice some of these indicators, most basic. And please be sure to subscribe to our channel, Empire Crypto TV, for more lectures and tutorials about trading and the basics of trading in itself. This Empire Crypto TV. Thank you very much. Until next time.